Now, according to my next guest, the Sell Australia theme has been in place for some time, but with the Aussie dollar gathering steam, some hedge funds are buying on the opening up story. To take us through it, alongside the broader economic outlook, Clifford Bennett joining us from ACY Securities. Clifford, good morning to you. So tell us then how this is playing out in the currencies market.
Good morning, Andrew. And as promised, no tie this week, though the sentiment is still the same. And also, I have to congratulate your previous speaker, who was so excited to get on your show. He hadn't taken his backpack off yet. I thought that was very, very enthusiastic indeed. In terms of markets, look, there's a little bit of buying of Australian dollar at the moment. I wasn't calling that. I still feel the Australian dollar could be in trouble over the medium to long term. But certainly, some of these higher commodity prices are a reason and a trigger, as is New South Wales opening up and the expectation that that Victoria will follow New South Wales in a similar pattern, but delayed by 3 to 6 weeks or so. I still think there's a high risk these two states could come out of lockdown but remain locked out from the rest of Australia, as other states are still enjoying totally normal lives, albeit with their economies slightly diminished. But they're not being ravaged by the virus in the same way that New South Wales and Victoria are. And if cases spike on the reopening in New South Wales and Victoria again, and hospitalisations spike, that's the only number that matters now, those states won't be keen to reopen. So there's still problems ahead and challenges ahead for the Australian domestic economy. But on the external front, obviously higher commodity prices are a great thing for the Australian dollar. Though we've had high commodity prices for some time, and also we've seen great volatility in commodity prices. So I'm not sure that's one that we would sort of put the house on in terms of the Australian dollar rally being sustained. We are still seeing US dollar strength, and that is stubborn strength. And that is safe haven flow to the US dollar, to US treasuries, because people feel that the world is still a very uncertain place. We may be all enthusiastic in Australia about New South Wales opening up, but in the rest of the world, there is heightened and significant ongoing uncertainty in consumer sentiment surveys, business surveys, in terms of supply chain disruption, and even, as we've seen, shelves in stores in the UK occasionally being empty and the army being called in to deliver goods, fuel there. So problems persist across the world. Inflation, and by the way, Andrew, congratulations. You were one of the first people I heard say on air the word stagflation about a month or 2 months ago. So well done, because that really is where the whole world is at the moment. And that's going to be the case for the US and the Australian economy as well. We're not going to see a strong boost out of this opening up. Looks nothing like the previous occasion. There is no after party for Australia on this opening up. Sure, people want to go to the shops, but they don't have the money to spend they spent last time. And they don't need any more sofas or furniture. That's all done, as are renovations. Hospitality sector is going to struggle. Many restaurants not even reopening yet because the conditions of the reopening are so complex that they probably would be losing money on reopening at this stage. So it's still a difficult reopening phase for New South Wales. And I think people are missing that point, as well as the risk further down the track. Australian equities, US equities look diabolical. This is not a healthy market. There have been warning signs about the US stock market, the US economy for months now, and I am meaning sort of 6 to 8 weeks. And the same is very true of Australia. We're going to see below trend growth for the foreseeable future, and by that I mean the next 1 to 2 years in the United States and Australia. And equities have already celebrated some kind of after party, and hence their weakness now, as the investment community begins to come to terms with this concept of stagflation. We're going to have sustained high inflation, as we've said on your show all along, and the economy is slowing.
Although, to be fair, I mean, not everyone agrees that stagflation is a risk going forward. But your argument is that the central banks have run out of ammunition. However, I mean, just as far as fiscal stimulus coming off, I mean, they could delay that, of course. You have to look at the states, maybe pushing back the taper even further, for instance.
Well, yes, we have to differentiate there. The taper, I think, will remain in place because really what's happening is the government's been borrowing money and the central bank has been buying bonds so they can borrow money at a good yield. And that's a highly problematic situation long term. Hence, the bond buying by the central bank has to continue to be unwound. In Australia, we should never have had it in the first place. The economy obviously didn't need it with all that stimulus that was already in place from the government side. And 0.1% zero interest rates. That was a big mistake by the RBA, and that is being unwound, and that will continue to be unwound. But in terms of the political will to go out and spend big again to support a slowing economy due to just really, and people aren't understanding why the US economy is slowing and why the Australian economy will be below trend going forward. The key reason for this is that all that stimulus brought forward out of the next 1, 2, or 3 years, all the potential normal economic activity that would have taken place then has been drawn forward, sucked forward into the past 12 months, leaving a little bit of a void of what needs to be done over the next 1 to 2 years. And that's what the predominant risk to the economy.
All right, just quickly then, Clifford, portfolio-wise, you're arguing then you should very much take a defensive outlook at this point.
Yeah, as we have for about sort of 6 or 8 weeks now. In fact, I probably called it too early. I was on the way up into that last peak. I was saying it's time to start looking at an active management of your investment portfolio. I mean, we live in a great age where we have all the tools available to us to very quickly be very nimble, especially as individual investors. We have got a huge advantage over large institutions. We can be very nimble, and we have all these sophisticated modern tools available to us to hedge our investment portfolio if need be. So if you do come to that kind of view and you start to see breakdown price action, for instance, in the US at the moment, we saw a false break to the upside. I thought it would be that, and now it's rolling back in on itself, and that's why I used the word diabolical before. These are warning flags that people ignore at significant risk, and also not recognizing the tremendous opportunity. Whoever plays best defense in a bear market is greatly empowered in the next bull market to take better advantage than anyone else. That's where you get long-term historic personal wealth lifts, is playing good defense in bear markets and then being powerful in a powerful position to take advantage of the next bull market. We are no longer in a bull market at this stage, is what my view is and what my warning is.
Clifford, thanks for joining us from ACY Securities.
Thank you.